Hello, everybody. Welcome to Friday, another Talk Money with Tom show. We're coming here live from Silicon Valley, and we are trying to help you improve your retirement, especially in the area of finance. We specialize in kind of talking about retirement planning, asset management, and tax planning. And we like to do that through answering questions. So send in questions that you have. We can try to answer them live here. You can send them during the week. We can do some work on them. We cover questions that come up from client, reviews that we have. And so you can send that to asktom@talkmoneywithtom.com right now if you'd like, or you can put it into the chat here on the YouTube channel if that works better for you. And we'll try to answer those questions live. Of course, we have this channel for a reason. We feel that education is important. The more that our clients and the public knows about retirement, how it works financially, and some of the ways to kind of maximize it, the better. So you can subscribe to this channel. You can hit the little bell to get notified when we put new content on here and start your kind of educational journey with this. And of course, we can meet with you too. Sometimes that helps to educate you even faster because we can specifically cover the things that are interesting to you. You go to our website. There's a link here on the site. Up in the corner, you see a button looks just like this book appointment button. And you can pick out a 30-minute time to meet with Ethan and I, and we can talk about your specific situation. So look forward to that. Always have a good time doing these shows, and hopefully you'll find something interesting that you can implement into your retirement from today's show also. Now I do like to start off each show with a summary of kind of what we saw happening in the market for this week. And so again, part of our specialization area for education that we emphasize a lot is just understanding the stock market and how it works and trying to demystify it a little bit. And the object would be that, the more that you know about the market, the more comfortable you'll be able to be. It's been a great vehicle for accumulating some wealth for a very long period of time. And, the more you know, maybe the more you can make. Yeah, it would be the idea. So here's a chart of the S&P 500. That very beginning of that was the very beginning of last year, which we hit our all-time high on the 4th of January. And you can see what happened, obviously, with that blue line that I drew in there was most of last year. Market was coming down. Every time it got to a new high, it was always lower than the previous high, and et cetera. And so now this year, we've had a great run, a really, really big pull all the way through. Couple of pullbacks here. Right, and so we're in the middle of one of these pullbacks right now, and there's a variety of reasons for that. And they're attaching all kinds of information. Oh, it's China and there's softness and all these types of things. But really, for me, when I look at what's going on with the market, it has a lot to do with kind of the supply and demand side of the scenario and how much a market is stretched one way or another. Mm-hmm. And I've been doing these videos, since the early 2020, and I always talk about this rubber band concept. So the market, goes along. If you take a rubber band and you stretch it, you can stretch it quite far, but it gets harder and harder, mm-hmm. The farther you get. And then sometimes it can stretch down too far and it'll snap back or snap, down if it's up. So the idea of stretch is important. And so I have a question that came from a client that I was meeting with this week, and most of you that's watched this show probably remember that about 6, 7, 8 weeks ago now, we basically made a call that we were going to have this type of motion, this sideways consolidation period. We've talked about it, I think, pretty much every week since. And he just wanted to know, how did you know, or what did you see that made you think mm-hmm. that this might happen? And so what I'm going to do is I'm going to try to, in a simple way, as much as possible, just kind of show, what I look at and how I can see stretch and those types of things. So the first thing, the green line there is the daily data from the S&P 500. We're not day traders, right? Mm-hmm. And so I like to look at longer term trends and kind of smooth out the data. And so one of my favorite things is what's called a 200-day moving average. Mm-hmm. And so I put it in here, you can see it. And so each point on that blue line is an average of the 200 days prior divided by 200. Yep. And you can see it just kind of smooths it out, all right? And I might also add a 50-day moving average, right? Just to be able to have something that's not quite as noisy as the price. And so the combination of a 50-day and a 200-day moving average is really common. It's a really big piece in the investment world. I'm going to go ahead and take the price out of there just so we can see those two lines. So now it's a little bit more clear, at least to me, kind of what we're looking at here. And so you can see, excuse me, we hit this high point back at the end of last year, at the end of 2021. Mm-hmm. And, came down throughout 2022. And so there's a couple of key pieces here. Number one, let's switch this up so you can see that a little bit better. When the 50-day moving average crosses through the 200-day moving average, so it comes from above and crosses through. It's actually called the death cross.
Yeah, you don't want to be seeing those.
No. And so that's the beginning. So for me, are we in an upturn or are we in a downturn, right? And that's kind of, I'm looking at direction of market because the market is big. There's a lot of money. There's a lot of momentum. It's like a huge ship. And once the ship kind of gets going in one direction, it'll tend to stay in that direction for quite some time, and it takes a while for it to shift back around. So that's a really important component for understanding investing. And so here we're seeing the beginning of that shifting and that turn is that cross. The other piece that I use is just when does the 200-day moving average start to go down? That combination to me, in a very simple terms, there's other things I look at, but if I only had these two, I would call that now the start of a downturn. 50-day moving average is below the 200-day moving average, and the 200-day moving average is going down. We're now in a downturn. And that means something to us because we do different things with how we invest the money and all these different things as far as that goes. But that's a downturn. Now, the opposite can happen. So here on February 2nd of this year, we had what's called the golden cross, right? Where the 50-day moving average crosses up through the 200-day moving average. And so that's good, good sign. We like to see that. And really just a little bit later, February 28th, we saw the 200-day moving average go up, right? Even just fractionally, count that. So now we're in an upward market.
Yep.
And look what happened. It actually turned out to be exactly right. So once that momentum gets going, back in February, you want to be invested in that. And you still want to be invested in this because this is an upward market. But when we look at stretch, what we're looking at is the difference between the 200-day and the 50-day.
Yep.
And so I'll give you an example on the downside. So here is a heavy stretch to the downside. So the 200-day is, much higher than the 50-day. And what's showing there is that the 50-day is actually 9.3% below the 200-day. That's a pretty big stretch.
Yep.
You get bigger stretches on the downside because there's two major emotions that are driving the stock market. The stock market is a representation of human emotion. That's important to understand. And fear, which is the downside, is stronger emotion than greed, right? And so you'll get bigger stretches on the downside. But that stretch became so large that you ended up with that bounce.
Yeah, and there's like a fear and greed index that a lot of people use. And so when a certain point reaches on the fear index, it's kind of like a buying signal. So people start to jump in.
Yeah, that's a contrarian investing concept where so many people are afraid they're already out. It just leaves the few people that aren't, and they can make a move. And so that stretch came back down to 5.3%. Now, that's an example. It gets overstretched. You're bound to have a move in the other direction because averages tend to work out. Now, this is still a down market. The 50-day is still below the 200-day, and the 200-day is still going down, even though there was a nice bounce in there. But you still want to be cautious in that arena because you're still in a down market as far as that goes. Now, if we go forward, and so to answer this gentleman's question, how did I know that we might be having some type of a pause, consolidation period? Because we got to a very healthy 7.5% stretch to the upside, right? As we were doing these shows, I'm seeing this, and that's not a bad thing.
Yep.
It just means the market is ripping this year. I mean, really going. And you can see now the 50-day moving average is kind of going sideways, right? And the 200-day moving average is still going up, right? But how much of a stretch is that? If we just go back just a little bit here, take a look at this chart, you can see prior to the 2020 big downturn from the pandemic, the market was about, the 50-day moving average is about 5.4% higher, right? Then at the top here, at the end of last 2021, beginning of 2022, was a 7.4% stretch, similar to what we have now, right? So right now we have consolidated. We were at 7.5%. We're down to 6.4%. I wouldn't be surprised though to see us get into that kind of 5% range, which means, you know, just even if it just goes sideways, the 200-day moving average is still going up. But that's what's happening here. You can attach, because China was having trouble during the big run-up, and all of a sudden now we're hearing about China, and keep in mind that the news attaches things to the market, and on a daily basis it can matter. A report comes out, you see something move. I report things on a daily basis, but as far as an investor, and you know, kind of a longer term investor who wants to stay in there and understand what's going on, you know, you want to be looking more at the kind of the basics, the supply and demand, and you can see that. See, the demand just was so high there, and you can see that stretch, that 7.5% move. You're bound to have, that's probably not going to 10% or, you know, 15% above the 200-day moving average. And honestly, you don't want that, because that's the problem. Sometimes you get so much stretch to the upside that the selling becomes pretty heavy, because it's just people taking profits. Wow, I just made so much money. And all of a sudden other people look at that and say, oh my gosh, the market's falling apart, and the selling becomes more and more.
Kind of like a contagion.
Yeah, and you can end up with a much bigger sell-off if you have too much stretch. I mean, 1999 is when I remember. I remember the NASDAQ, maybe it was 98, NASDAQ doubled that year. You know, that's a pretty heavy stretch, right? It was just crazy. And then you get kind of, you know, the panic selling that can come. So these normal scenarios where it just takes a rest, you know, that's pretty standard for how this works. And now keep in mind that all this means is that for like new money for us coming in, we're kind of going to sit on that new money as we watch this stretch kind of dissipate, and we're more interested in getting in because at a lower point, or at a less stretched point, because it's still an up market. You want to be in the up market altogether. Matter of fact, it's too much of an up market. That's why it's slowing down. But that's a really good sign. When it gets in these type of markets, that's a lot of momentum. And to say that that's going to reverse, it could do that. But let's wait and see. Let's keep going and see what happens and kind of react to these things. And again, actually in the same conversation, one of the things that came up was just, again, and I'll reiterate this, it comes up all the time. Most of what we're looking at in the news, when we watch stuff and we read stuff, is a projection for what's going to happen. And what we advocate and what has worked for us is more of a reactionary concept. So the advantage to a projection, if you're right, you're actually early, or at least on time. And if the market's going to fall, you have a chance to get out at the top, right? Versus reactionary, we need to let it come down some.
Yeah, for example, at that golden cross, you could have gone in at a lower point and made more money if you had made a prediction rather than reacting. Because
the golden cross was February 2nd, right? The up motion in the 200-day moving average was February 28th. So sometime in that time frame, you would be reacting, okay? But the low was October 13th, quite a bit before. And there's a pretty big profit to be made. So if you were able to project that this is the low and that we're going to buy here, you do better. That's the advantage of projections. And unfortunately, most projections are wrong. I mean, I'm saying this emphatically because I read all of these things constantly. And one of the things that just kind of amazes me is, you know, how wrong it is. And actually, the more people that are thinking one thing, the more likely they're going to be wrong. Because at the end of last year, the fourth quarter of last year, I'd say the consensus was something in a 20% down motion in the first half of this year.
Mm-hmm.
Look at what happened. Exactly the opposite. We actually ended up with a really strong up market. Now, keep in mind that part of the reason that you get a big up market like that when everybody thinks it's going to go down is because they might all be shorting the market. And so if they're shorting the market, they're betting on it going down. And if it doesn't go down, they actually have to buy the stock back that they shorted. And when they do that, of course, it makes it go up even more, right? So that may be a big piece of the reason why we saw part of this run up. The other part, again, the news has been attached with the artificial intelligence, and wow, that's exciting. And so we're getting some potential heat from that, especially companies like NVIDIA and what have you too. So anyway, altogether right now, and this is more of a longer term look instead of just a weekly summary, but the market is quite healthy, right? The market is one of the leading economic indicators, LEI. I'll look it up. It is one of the best indicators for economic health. There are only 10 indicators in that basket. Housing starts, all these different things are in there. The S&P 500 is in there also. And so what's happening is the S&P 500 is telling us that the economy is going to be decent coming up here. That's what it says. And now, sometimes it's wrong, but the market's pretty accurate. It's why it's in that basket. and there's a lots of other things that we can point to that are showing okay things. But until we start to see that 50-day moving average getting a lot closer, I mean, we're 6.4% away from, that's a pretty big stretch if you look at that. Until we start to see that getting closer and closer, maybe crossing the 200-day moving average, we see when we look at the price, we start to see some of the lows that are established that are lower than the previous lows, because we haven't seen that so far in this. We have 4 lows, all higher than the previous, right? One of them maybe comes below, and okay, that's another warning sign. So what we watch for is change in direction, major change in direction. And right now, that direction has been up and continues to be up. And so you should stay invested. Stay with your concepts. We're using a lot of technology investments for our, target parts of our portfolio, which is the smaller parts, but nonetheless, that's how we juice the portfolio, and that's working, and we will stay with that until, it doesn't work. And so far, so good. So anyway, that's what's happening this week, just trying to explain kind of the rubber band in charts, the rubber band concept that I've been talking about for a long time, which is just a stretch. And so you see that, and I look at it and say, we get to 7.5% above the 200-day moving average. That's too far. We're probably going to have some type of either pullback or sideways motion, and we basically have had both. So I think things are still intact. I wouldn't be surprised though if it doesn't take a little while for it to get running again. Just because we need to close that gap up, in my opinion. September historically has not been a good month, not a terrible month, but it can be a good month. But on average, seasonality is against us. Yeah, seasonality is against us. So that's okay. Let's just cruise through September, go sideways, come down a little. It's fine. As long as the market gets a chance to kind of reconsolidate and get back to a healthy place. If we want to go to the all-time high that we set back at the beginning of 2022, we need this period of consolidation. And so does it turn into a downturn? I don't know. We'll see, right? That's what we'll watch for. But so far, that's not what we're seeing, And you can really, instead of trying to project where it's going to go, just look at it and accept where it is and be able to say, okay, we're here. This is all right. And, until that changes. So anyway, thank you for watching this week's summary, and really look forward to being able to present this again. Next week we will actually be on a break, and we won't have the show, but we'll be back in 2 weeks. So, all right, let's start with our next question.
What is break-even age for Social Security?
What is break-even age for Social Security? Yeah, this came up in a client meeting. And so, once you're 62, you can start to take Social Security. By the time you're 70, you definitely should have taken Social Security. Well, you don't have to, unfortunately. Actually, I met a 71-year-old who hadn't taken his yet, and that was a mistake because you don't get any growth past age 70.
Yeah, you're giving up free money.
Yeah, it was a mistake. But so generally speaking, it's 62 to 70. And so the question always becomes, okay, if I take it at 62, I'm getting money. And if I wait till age 70 or whatever, 65 or whatever it is, I've given up the ability to get that money, right? And yeah, I know I'm going to get more, but I'm not getting anything for this period of time. And so how long do I have to live till that extra that I'm getting in the future will be worth more? And so we've got a little chart here for you. Let me share my screen this way so we can all see it a little bit better. Okay, lots of numbers here, but just real simple. I'll point out the stuff that matters. So here's a hypothetical person who is thinking about taking it at age 67 versus taking it at age 70.
Yeah, his full retirement age
Right.
versus 70.
Yeah, full retirement age is just, used to always be 65, right? My father's was 65, and now it's a different number because they moved it back, and they had a phase. You could have 66 in 1 month, 66 in 10 months, or 67. So 67 is the farthest one. They may change that again, and I wouldn't be surprised. But so let's say full retirement age for this person at age 67, or take it at age 70. And so if we look at, I put some arrows on the two columns that matter. If you look at the first one, the green column there, you can see there's money coming in, 30,600, and then there's more money coming in. Now we're up to 61,000. 3 years later, 93,000. So by taking it early, they got $93,000 more than the other column, which has all zeros.
Yep.
Right? So they didn't get anything. So that's the question. I'm giving up $93,648 on this projection, and I know I'm going to get more in the other one by waiting. Okay, so just to be clear, when you wait, you, in this particular case, full retirement age and beyond, you get an 8% increase in your Social Security each year that you wait.
Yeah, so you can kind of see that difference. When he takes it 67, his monthly amount is $2,550.
Right.
Versus 70, it's $3,496.
That's right.
You can see that difference there.
That's a massive difference. That's just 3 years. You also get the cost of living increase in there also, which has been really high lately. So even though you're not taking it, you're still getting the cost of living increase as if you did. And there's other advantages too if you don't need the money, particularly. Who doesn't need money? But
if you can survive without it,
right? So. Yeah. Then you also don't have to pay taxes on it, until you get it. And there's other advantages. But yeah, you go from $2,550 to $3,496. How fast do you make that up? Well, if you look at that where the arrows are, we have these bolded numbers there, and all the way up till age 79, you end up with more money in total. Right, that you got from Social Security. So up until age 79, you got $449,208 on a projection basis from Social Security. And at age 70, you're at 445, 411 if you took it at age 70, right? At age 79, you got that much in total. But then it crosses over. And so the break-even point for this person is age 80, right? And now, look, life expectancy for somebody who's already 67 is past age 80 on average. And so on average, this particular person would be better off waiting till age 70.
Yeah, for this life expectancy that this program has set, on average for a male is 84 years. So you would, by delaying, you would actually make that break even.
Yeah, and so you got more money coming in totality for your life. And, it really kind of adds up. And so, we've run into a few cases where, because, 58% of Americans take Social Security at age 62. And I think that there's 3 reasons that I've run across that come up all the time. Number one is people need it, right? They can't afford to not have it. They don't have any other resources. The average 65-year-old doesn't have much money in this country. So the average person, when they can get free money from the government, is going to take it. Then there's another group that is worried Social Security is going to go out of business. So they want to take what they can take while they can take it. And, my father was one of those people. And, he's now 85. So he was better off waiting. Yeah. The other group that takes it is because they don't think they're going to live that long.
Yeah.
So if you're 62 and your break even is, say, age 80, they worry that they're not going to get to age 80. Maybe because they have some health issues that they think,
Yeah, family history or something like that. You
or
know.
yeah, they already have something that's, that they've been getting treated for, and, taking it early. To me, that makes some sense. It's the one argument to take it early, if you don't think you're going to get to the break-even age. And maybe you do, and you're wrong, but still, that's a factor that I pay more attention to than Social Security going out of business. It's not going to go out of business.
I think if Social Security changes, it's going to be for the younger generation.
Yeah,
They're not going to allow people who've planned around Social Security to fail, essentially.
yeah, I don't believe so at all. I take a class on Social Security, and it's always kind of funny. They have these different headlines and magazine covers that they always bring up. And back in 1941, there was a Time magazine cover saying Social Security is going out of business. So it's been going out of business for a long time, and it's still here, still going. And that's a question that comes up all the time. I mean, people believe that as if it's fact. But the fact is that it's too easy to fix. Will they change Social Security to make it so that it continues to go? And do you get less benefit because of that? Especially if you're in the younger generation?
Most
Yes.
likely.
That's already happened. My father is at full retirement age was 65. If I take at 65, it's actually early because my full retirement age is 67. That's an adjustment that they made to keep things going, and that'll continue.
And it might be 70 for my retirement age. They may change it up.
It could be. I think 69 is probably in there someplace at some point. There is a limit to it, so you won't have to debate too much. But it is, that argument I don't think is there. I think that really, if you have a health issue, but we run a lot of these, and we've got a lot of clients that are waiting for their Social Security. We've found, the other places to get money. And here's something that's super important. This comes from Savvy Social Security. This is a very generic look at it,
Yeah.
and that's how we wanted to do it. Because what it's not saying is where are you going to get the money during that 3-year period. So you still need money to live off of. You could get it from Social Security. You decide to delay. Where are you getting the money from? And how much tax does it take to get that money, if it's in an IRA or something? And what rate of return are you getting on that money that you will no longer be getting?
Mm-hmm.
And so when you do this analysis inside of a financial plan, it can look at all of that.
Yeah, you can get much more detailed.
Oh, yeah. Then you'll get a much better idea of what really works or not. And you combine that with Monte Carlo simulation and all these things. And because basically, again, those are the parameters. I'm not going to take it. And so where am I going to get the money? How much is it going to cost me in tax? And what rate of return am I giving up? And do those things add up to more than I might gain by waiting, right? And so if you run a plan, the plan might say, oh, you should take this earlier because you'll maximize out because of the structure of your other assets and the overall outflows that you already have in your retirement.
Yeah, it's pretty hard to beat delaying Social Security because you're getting 8% guaranteed.
Yeah, that's right. Yeah, guaranteed from me. That's hard to get. So, yeah. Anyway, it's a great question. Glad that this came up. I think it's something that is, it's worth considering. It's very difficult to get high quality information, in my opinion, on Social Security and how to maximize it and what have you. Prior to the pandemic, I used to do, Social Security Maximizer seminars. They were very popular. We always had a full boat every single time, and so it's something to keep looking at. It's very complex, and there's a lot of ways that you can really make more money from Social Security just by understanding.
So our next question is, what do I need to have my estate in good order?
Yeah, over the years, I've seen a lot of different estates. Whether that was a new client that's coming in and their spouse passed away, or an existing client who passed away, and it's really kind of interesting because once in a while we run across one where there was plenty of money, but it was just in disarray.
Yeah, it wasn't done recently. It would just kind of been forgotten about and just.
And usually it's a spouse that I'm thinking of, and there's a couple stories that I've dealt with where they don't know where anything is. They don't know where the money is. And I remember one case where we spent 3 years finding the money. and it's a good problem to have. We've found it and kept finding it, but it makes me wonder how many times where people didn't have things kind of established, and there's more than this that's important for this question, but how many times does that money not get found and end up going to the state? I keep seeing these stats. There's billions of dollars sitting in accounts that there's no action on, nobody's dealt with, the person's passed away. So I think that's important for starters, is just, have a list of where everything is. It doesn't need to be real sophisticated. Put it on a piece of lined paper, write down the accounts, and maybe just the last four numbers, or something. You don't want to have all your account numbers on a piece of paper sitting in your desk per se, but put those last numbers just for whoever your beneficiary is and let them know where that is. And then if you close an account, cross it out, and put in, whatever new ones on there. And that's it. I mean, I'm telling you, that would be a huge boon to whoever finds this stuff, is just to kind of know where things are. That's critical. Now, I've seen people go way farther than that and have, spreadsheets all set up so it's password protected. The person that's the beneficiary has been, seen that spreadsheet, has the password, knows where to go to get it. Back in the day before all the spreadsheet stuff, I remember a couple of people had full-on binders, with all the stuff, the auto policies and all of the, pink slips to the autos, everything was kind of organized, and that's really nice too. Believe me, I think that's really, really taking care of your beneficiaries, which is a nice thing to do. And most of the times the people that are the most sensitive about this type of stuff, they went through another scenario, maybe with their parents, and they thought, well, I don't want to do this to my beneficiaries, because there's plenty to deal with. Even in an organized scenario, there's a lot of stuff in a house and, all these things that might have to dealt with, and it's a lot of work. And to not know where anything is on top of that, it can be tough. So
so basic checklist is you should have a will, and if your will has some sort of trust associated, have that trust document somewhere. You want to have any kind of power of attorneys, whether that's springing or durable, prepared. And then
so explain the difference between the springing and durable.
So a springing power of attorney is if something happens. So you need a condition to occur. So it could be like most common one is I'm incapacitated in some form. I get into a car accident, I can't make any decisions anymore. So that allows that person to become power of attorney for me.
Yep.
Durable is it kind of continues. It's lasting until it's revoked, essentially.
Got it.
And so you want that. And then another one that's quite new, I would say, is advanced medical directive. What do I want to happen if I become a vegetable? And so do I want them to remove life support? Do I want them to continue life support? Kind of spell out what you want to happen for you if you weren't able to tell people what to do.
Yeah. So you get all of those in order. You have a list of accounts where your money is so that somebody can go find it and it doesn't get lost. And I think that's a really good start.
Another thing that you kind of want to check on a regular basis is on your accounts that have beneficiaries. Are they up to date? Are they what you want them to be? That's a super easy one. You can reach out to any of your whoever is the account holder or custodian, and they'll easily make those changes for you.
Yeah, over the years, I've run into scenarios where somebody passed away and left a 401k without a beneficiary. And so there's maybe siblings, that are beneficiaries on everything else, and they were probably supposed to be beneficiaries on this 401k. Just for whatever reason, when they got set up, it just didn't get recorded. And wow, some of those take years and years to get, because you have to go through the court system to prove that you are the beneficiaries, on all these other things. And so, somebody's got to be the beneficiary on that 401k. And some of these things it's big money. But so that's a really important component of getting things in order, is just making sure that you do have beneficiaries, and obviously the ones that you want would be important also. So it's a good question. It's a kind of a weird subject altogether, but It's part of stewardship and, just making sure that your hard work is going to take care of you for as long as you're here, and then maybe somebody else can get something out of
Yeah,
that
pass
too.
your legacy on.
Yeah. Yeah. So, why not make it, organized and not have some of it go off to the state or something crazy? So,
And the nice thing is, once you make that first will or trust, it's just updating it, so it's a lot easier the
yeah.
second time.
Yeah.
It's not like as arduous. So doing it, just taking that bullet for the first one is the hardest.
Yeah. Yeah. It's hard to get it all set up and organized, but once you do, it's not that hard to maintain. Yeah. That's good. It's a good question. Right?
Can I reduce my retirement savings if I know I'm going to have a pension?
Yeah. So, got a pension, and which is for your retirement. It's going to be a cash flow that comes out. The reason you're putting money into retirement assets is predominantly for your retirement, so you have cash flow to replace your income. And so they're, somewhat similar. It really depends on the size of the pension. I mean, it says reduce, not eliminate my retirement savings. So it's got to be somewhat proportional. If your pension is going to be $100 a month, then you wouldn't want to reduce your retirement savings by much, because that's not going to help. If it's $2,000-3,000 a month, then that does make a difference as far as that goes.
One thing that I always ask is, does my pension and do I still get Social Security if I have a pension? Because a lot of government jobs have pensions, but they don't pay into Social Security system, so they don't get Social Security.
Yeah, exactly. So, it comes down to kind of on a planning basis. You have these inflows, whatever they are, Social Security, pensions, rental income would be another one I'd probably throw into that kind of inflow concept. And you're going to have these outflows, and you have to save to fill that gap. Mm-hmm. So if you have Social Security and it's great and high, and you have pension and it's great and high, your gap is going to probably be less.
Yeah.
So maybe you could reduce your your retirement savings. However, I would be really interested in looking at this person's 3 buckets, that we talk about: the taxable amount of money in taxable, the amount of money in tax deferred, like IRAs and 401ks, and the amount of money that is in a Roth IRA, tax-free. Those 3 buckets. Taxable being like just normal brokerage account. And because what we see oftentimes is, especially in the Valley here, is that it gets very skewed. A majority of the money is in tax deferred. Yep. Because people have a 401k, they get a match, and they use that. And we didn't have the tax-free Roths and, Roth 401ks and those types of things for that long. So there's a lot more money in the tax deferred. So if I had a big enough pension and Social Security and I had less need for that, I might be looking at saving some of that money into some of these other buckets, right? So first of all, you want to get your match. If you're working at a place that has a match, doesn't matter whether you have a lot of pension, you should still be putting that in there, because your match is 100% rate of return.
Yeah, you're guaranteeing a return.
Yeah, and so now, if that company that you're at, if they have a match, that's great. If they have a Roth 401k, even if I don't have a match, I might still be putting some of my retirement savings there, even if I have a pension and Social Security, because tax-free growth is something I'm super interested in.
Yep.
If you want to have a powerful retirement, get to tax-free growth. So you put money into your Roth 401k, you don't get the write-off, right? Mm-hmm. So you have to pay the taxes on it, and then it goes in, and so that can be onerous. But in exchange for that, you get tax-free growth for the rest of your life. So let's say that that's not available, because that's the first choice. Yes, maybe we cut back on the tax-deferred, because we have great Social Security and pension or whatever it is. I might look, though, after the Roth 401k concept or even the Roth IRA concept, I might look at the taxable accounts and start building those assets up, because what happens is, at least from our perspective, we get questions, my son needs to borrow $100,000 to buy a house, and they have all their money in retirement plans. Mm-hmm. You can't get to it. Because $100,000, you need to pull out 140 and pay 40 in tax, and your son's not going to have that much money to pay you back all that interest either. So having that 100,000 already out in a taxable account, you might be able to get that out with a lot less tax, because you already pay taxes on some of that money, And then any growth that you have, if you had it for more than a year, will be at long-term capital gains rates, which are much lower. And so, that aspect is something to consider. And it really goes back to our three buckets concept and having some balance between taxable, tax deferred, and tax free. That's critical. I've seen it so many times within the practice. And when we do see it, wow. I mean, we were working on a case last night where pretty good balance. And man, they got a lot of power in what they can do with their retirement and, Roth conversions and all these different things that are possible. It is really, really powerful. That three bucket thing is something to pay attention to. So if you have a lot of pension money, maybe, and you still want to save something, look to the Roth concept, get the tax-free growth. And if you don't have that or filled that out and still have more money, then start looking at taxable, as far as that goes. So it's a good question. All right, might have time for one more.
Yep. When can I start collecting spousal benefits on my partner's Social Security?
Okay, so the way Social Security works is that you get your Social Security or half of your spouse's, whichever is higher.
Yep.
So let's say that I'm going to get $500 a month in Social Security, and my spouse is going to get $3,000.
Mm-hmm.
Well, I could get $1,500 instead of the $500.
Yep.
Right? With one caveat.
Yeah. So your spouse actually has to be collecting Social Security. So if your spouse is delayed until 70, you have to wait till they start to actually get that spousal benefit.
Yeah, and here's the thing. You pretty much want the bigger one, the $3,000 in this case, to wait.
Yep.
Because it grows. Might be $4,000 or $4,500 by the time you get to 70.
Mm-hmm.
Because when one of you passes away, the bigger one will remain and the smaller one will disappear. And so making the bigger one even bigger is a recipe for great success in retirement.
Yep.
It's a great place to start, and you're protecting that spouse. And so unfortunately though, I could get 500 and I could have gotten 1,500, right?
Now it'll be you'd have to have some sort of calculation to do that comparison, where's break even or what's the best point.
Yeah, and that's part of these, these calculator programs. But you could take your Social Security and then wait and keep taking your Social Security, and then once your spouse starts taking their Social Security, you can take half.
Yep.
Right? And so you can get a jump up. And so it's kind of, here's another detail that's a little interesting in that you got $3,000, let's say Social Security at full retirement age for your spouse, and $500 for you.
Mm-hmm.
If you take yours earlier than full retirement age, let's say 62 or 5 instead of 67, you're not going to get 500. You're going to get less than 500. Let's just say 400. You're also going to get less than half of that, because they reduce proportionally, essentially, the half of Social Security. So you got to be a little careful about taking your portion early. Let's just say, for the sake of argument, that you take it at full retirement age, you get your full $500.
Mm-hmm.
And your spouse is waiting until age 70, and let's just say you're the same age, so it's 3 years later, you get half. Now, you don't get half of the new bigger.
Yep.
You get half of his full retirement age Social Security, which is $3,000, and maybe he's going to get $4,500 at age 70 if it grows. You're not going to get half of $4,500. You're going to get half of that $3,000, but still, you're going to go from $500 to $1,500, and your spouse is going to get, say, $4,500. I'm making these numbers up.
Yeah.
And you're going to have a big jump in income. All of a sudden, you're getting $6,000 a month from Social Security. You were getting $500. So,
yeah, and then it's essentially another break-even question. Mm-hmm. Are you going to, can you live long enough to make that worthwhile?
Yeah, exactly. So you want to run that through the calculators and run that through the financial plan to see, when that optimal period is. Because sometimes it actually makes sense to take yours early, even 62, and you're only getting 350. But when you do all the math and you do that inside your financial plan and you look at where the other assets are going to have to come from, you can get the answer. And so, if you have these type of questions, come talk to us. We'd be happy to, work through these with you and make sure that you're, getting the most that you can out of Social Security, which I think is important. All right, then. Perfect timing. Another show in the books. Again, we won't be here next week, but we'll be here in 2 weeks. And so look forward to seeing you then. Send in your questions. Give us some time to work on them. Send them to the Ask Tom at talkmoneywithtom.com email address and let us know, what you're interested in, and we'll answer those. That's where we got some of these questions today. And then, of course, you can subscribe to the channel. Start your educational journey here. I think we have a lot of good resources. You can hit the little bell button if you want to get notified, when we're, putting new content on. And you can set up a time with us. We're friendly, and we're really interested in trying to help. We like to hear all the different situations, and so you go to our website, hit the book appointment button, and you can visit with Issa and I for half an hour, and we'll see if we can help you, and we'll go from there if we can. So look forward to seeing you in a couple weeks. Thank you very much.